In the quiet corners of the financial world, a massive industry is reshaping our economy, and most people have never even heard of it. It's called private credit. It operates in the shadows, away from the public eye, growing at a staggering pace. Imagine a long, silent corridor. Down this corridor, deals are made, promises are stacked, and numbers that look harmless on paper start to twist into something far more fragile than anyone wants to admit. Private credit was born out of the 2008 financial crisis, stepping in to fill a gap left by banks who were suddenly afraid to lend. It seemed like a perfect solution. Sophisticated investors providing much-needed capital to businesses, all without the red tape of traditional banking. Today, this market is worth trillions, and it's become the go-to funding source for countless companies. On the surface, it's a story of innovation and success. But what if this story has a hidden chapter? What if the very silence that allowed it to grow is now hiding a growing danger? To understand the risk, you need to understand how private credit works. It's not like getting a loan from your local bank. These are bespoke, privately negotiated deals. Imagine a mid-sized company that wants to expand. Instead of going to a bank, they go to a private credit fund. This fund, backed by wealthy individuals, pension funds, and insurance companies, will write them a loan. The terms are flexible, the process is fast, and everything is confidential. Sounds great, right? But this flexibility comes at a price, and that price is often paid in the form of weaker protections for the lender. These are called covenants. Covenants are the rules of a loan. They're the promises a borrower makes to maintain their financial health, like keeping their debt below a certain level or maintaining a certain amount of cash flow. In the world of private banking, these rules are strict. Break a covenant, and the bank can step in immediately. But in private credit, these rules are often much looser, or sometimes they're barely there at all. They're called covenant-light loans. It's like lending someone your car but telling them, "Don't worry about the speed limit, and it's fine if you get a few scratches." For a while, everything seems fine. The driver gets where they need to go faster. The lender is happy because they're earning a high interest rate. But what happens when the road gets slippery? This is where the real problem begins to surface: leverage. Leverage is just a fancy word for debt. In private credit, it's everywhere. The funds themselves use leverage to boost their returns. The companies they lend to are often loaded with leverage. And then there's another layer. Many of these loans are bundled together, sliced up, and sold to other investors in complex structures called collateralized loan obligations, or CLOs. It's leverage on top of leverage on top of leverage. It is a house of cards built on the assumption that the economy will keep growing and that companies will always be able to pay back their debts. For the last decade, that assumption has held true. Interest rates were near zero and money was cheap. It was a perfect environment for private credit to thrive. But the world has changed. Interest rates have shot up, making it much more expensive for companies to service their debt. The economy is slowing down. Suddenly, those loose covenants and high debt levels don't look so smart. That faint hum you hear isn't the sound of a well-oiled machine. It's the sound of a structure under stress. It's the sound of a building carrying more weight than its foundations were designed for. We're already seeing the cracks appear. Small adjustments are being made behind the scenes. A repayment schedule is softened here, an interest coverage ratio is reinterpreted there. These are called amend and extend deals. Instead of letting a company default, the lender agrees to change the terms of the loan, pushing the problem further down the road. It's a way to keep the official default numbers artificially low and pretend everything is okay. But it's just kicking the can down a road that's getting shorter and shorter. Each amendment, each extension, is a small confession that the original deal was too optimistic. So, who are the players in this silent game? On one side, you have the private credit funds themselves, names you might not recognize, like Blackstone, Apollo, and KKR. They manage vast pools of money and have become some of the most powerful players in global finance. On the other side, you have the borrowers, everyone from well-known brands to thousands of smaller, privately owned businesses that form the backbone of the economy. And then there are the investors, the pension funds and insurance companies who have poured billions into this market, chasing higher returns. They're all connected in this intricate web, and the problem in one corner can quickly spread to another. The regulators are starting to get nervous. They see the parallels to the subprime mortgage crisis of 2008. Back then, it was risky home loans bundled into complex securities. Today, it's risky corporate loans. The details are different, but the core ingredients are the same: excessive leverage, weak protections, and a lack of transparency. The problem is, because this market is private, it's incredibly difficult to see what's really going on. No one knows the full extent of the leverage. No one knows exactly how fragile these loan agreements really are. It's a black box, and the regulators are trying to peek inside before it's too late. The big question is, what happens when the music stops? What happens when a slowing economy causes a wave of corporate defaults? Because of all the leverage in the system, the losses won't be contained. They will ripple outwards. The private credit funds will take a hit. The investors in those funds, including pension plans that millions of people rely on for their retirement, will feel the pain. And because private credit has become so intertwined with the real economy, a crisis in this market could trigger a wider recession, leading to job losses and business failures. It's a domino effect, and the first domino is already starting to wobble. This isn't about fear-mongering. It's about understanding risk. For years, the narrative around private credit has been one of pure upside. It's a safer, more stable alternative to the volatile public markets. But that narrative is starting to crumble. The silence that once felt like a sign of strength now feels ominous. The danger in finance never comes from the risks you can see and measure. It comes from the risks that are hidden, the ones that build up quietly in the shadows until they reach a breaking point. The insiders know this. They know the strange comfort that comes with the illusion of control. But they also know that models built on the assumption that tomorrow will be just like yesterday are destined to fail. Every financial cycle has its own unique crisis, but they all share a common theme. The moment you believe this time is different, you are inviting disaster. The belief that private credit is immune to the laws of financial gravity is a dangerous fantasy. So, what you're witnessing is the part of private credit no one explains, the part that holds the warning buried deep within its structure. The quiet adjustments, the hidden leverage, the illusion of stability, it's all part of a pattern. A pattern that has repeated itself throughout history. And once you understand how this world really works, you understand why its quietest moments are the ones that should concern us the most. Private credit didn't just appear out of nowhere as the trillion-dollar industry it is today. It started small, as a workaround, a quiet solution born from the rigid rules of traditional banking. To really get why it's so huge now, we need to rewind the clock. Go back to a time when lending was simple, when a lender was a bank, watched over by regulators, taking in deposits and loaning them out. That world started to crack in the early 1980s. Remember the Volcker shock? Interest rates went through the roof, and banks got scared. They became super selective, turning away borrowers with even a hint of uncertainty. At the same time, investors were desperate for returns that could beat runaway inflation. This created a gap, and into that gap stepped a new kind of creditor. These weren't banks. They didn't have depositors to protect or the same rulebook to follow. They were willing to take risks where banks wouldn't, offering specialized loans to companies that didn't fit the traditional mold. The seeds of a new financial model were planted: credit without deposits, without the usual oversight, and without the public scrutiny that banks faced. Then came the 1990s. This decade quietly reshaped global finance. Deregulation, the rise of complex financial products, and globalized capital markets all squeezed the profit margins for traditional banks. This opened the door even wider for non-bank players like insurance companies and pension funds to step up their lending game. Banks were still the kings, but an underground river of alternative capital was starting to flow. Companies got more comfortable raising money outside the banking system, and investors were warming up to the idea of credit risk beyond boring old bonds. But the real turning point, the big bang for private credit, was the 2008 global financial crisis. The crisis didn't destroy the credit system. It split it in two. When the banking system nearly collapsed, regulators came down hard. They jacked up capital requirements and slapped new restrictions on what banks could do. Suddenly, making loans to anyone but the most perfect, blue-chip companies became a massive headache for banks. They became less willing, and in many cases, less able to lend. But the economy still needed fuel. Businesses still needed loans to grow, to hire, to operate. And who stepped into this massive void? Private credit funds. They had no Basel III rules to follow, no depositors to worry about. They were free to write loan contracts that banks couldn't touch, to underwrite risks that banks wouldn't dare consider, and to do it all away from the prying eyes of regulators. The very crisis that was meant to make finance safer ended up birthing a massive, unregulated shadow banking system. And then something powerful happened. It wasn't about rules or regulations. It was about belief. A story took hold in the financial world. The idea that private credit was actually safer because it was part of the fragile banking system. Investors were told it was relationship-driven, well-structured, and insulated from the wild swings of the stock market. This story became incredibly compelling as central banks pushed interest rates to zero. Yield was impossible to find. So, pension funds, university endowments, and giant asset managers all piled into private credit, believing it was the holy grail. High returns without the daily drama of public markets. Borrowers loved it too. Private credit lenders were way more flexible than banks. They offered better terms, looser rules, and were happy to structure deals that kicked loan payments far down the road. But here's the catch. This flexibility that everyone loved? It was being paid for with leverage, with debt, that most investors couldn't even see. To understand the hidden risk, you have to look at how these funds actually work. The first private credit funds were simple. They took money directly from investors and lent it out. But as the market got crowded and returns got harder to find, the funds started borrowing money themselves. They got credit lines from the very same banks they were competing with. It's a bit ironic, isn't it? The more these funds grew, the more complicated their own borrowing became. Loan agreements went from being strict and full of protections to covenant light, meaning borrowers had a lot more wiggle room. Complex unitranche structures emerged, bundling safer senior debt and riskier junior debt into a single, opaque instrument. Risk was being sliced, diced, and redistributed in ways that looked brilliant on a spreadsheet, but were incredibly hard to track in the real world. The industry called it bespoke financing, but bespoke is just a fancy word for opaque, when you can't see the leverage underneath. By the mid-2010s, private credit was a core part of corporate finance, especially for mid-sized companies that were too small for the bond market and too risky for the newly cautious banks. But almost nobody noticed that this entire boom happened during a period of historically low defaults and a steadily growing economy. Stability hides fragility. As long as everything was going smoothly, the hidden leverage inside private credit didn't matter. But whenever there was a tiny bit of stress, a bad quarter for a company, a brief market panic, you could see the cracks. Instead of letting a company fail, funds would just amend the loan, extend the maturity date, and pretend everything was fine to protect their own valuations. The system wasn't resolving stress. It was learning to hide it. The big lie everyone believes is that private credit is safer because it's private. That opacity means stability. That flexibility means strength. But financial history teaches us the same lesson over and over again. Complexity without transparency rarely ends well. What makes private credit so fragile today isn't just its massive size, or the fact that many of its borrowers are on shaky ground. The real vulnerability is the architecture of leverage built inside the lenders themselves, the web of credit lines, obligations, and covenant-light deals that have piled up over a decade of chasing yield, and yet the public story never changed. The financial press called private credit a stabilizer. Investors cheered its returns, borrowers loved its convenience, and regulators, who couldn't see inside this non-bank world, just watched from a distance. The silence became its own justification. The bigger it got, the more people assumed its size was proof of its safety. But growth isn't proof of safety. It's proof of demand. And demand is driven by incentives, not stability. By the early 2020s, private credit had become the ultimate symbol of our post-crisis financial system, a giant credit engine running outside of traditional oversight, fueled by leverage that was built up quietly, one deal at a time. In every financial system, there is a moment when the story people tell themselves no longer matches the reality of the structure they've outbuilt. For private credit, that moment is getting closer. Not because the lenders are reckless or the borrowers are weak, but because the system has grown into a leveraged giant with no natural shock absorber. And as history shows, systems without shock absorbers don't break with a loud bang. They break when one small shift reveals just how much weight the silence was carrying all along. The turning point for the private credit market didn't happen with a bang. There was no big headline, no sudden crisis announcement. It happened quietly, inside boardrooms, where the once solid assumption that companies could easily refinance their debt started to feel wobbly. It started with small, almost unnoticeable delays. Borrowers needing just a few more weeks to finalize their financial projections. Lenders asking for extra clarifications on cash flow forecasts. Legal teams spending hours redrafting clauses that used to be standard. On their own, these moments were nothing. But for insiders, they were the first tremors. They knew that private credit, more than any other market, is built on a foundation of unbroken continuity. And when that continuity starts to thin, the hidden architecture underneath begins to show. Here's the real twist. The industry's greatest strength, its flexibility, had slowly morphed into its biggest dependency. For years, during the good times, lenders granted amendments, loosened covenants, and extended loan maturities. It seemed smart. But each one of those small concessions created a path that led to lenders becoming increasingly obligated to keep the music playing, to maintain the illusion of stability at all costs. It stopped being about helping a company improve its performance. Instead, it became all about protecting the marks. What are the marks? They're the valuations whispered in private meetings, the expected returns that keep investors confident, and the perfectly smooth quarterly updates that reassure everyone that everything is just fine. Insiders saw the system cross a critical line. The moment private credit stopped acting like a lender and started acting like a caretaker for its own investments. This pivot became even more obvious when the first real pockets of stress appeared. Not a catastrophe, just a slight slowdown in a company's ability to cover its interest payments. A small dip in earnings. A little softness in cash flow. But these minor tremors revealed something the public never gets to see. The private credit funds themselves are leveraged. The banks lending to the funds wanted reassurance. Investors demanded that same old stability. And the companies borrowing the money needed even more concessions. Caught in the middle was the private credit fund trying to manage a fragile web of obligations that had grown far more complex than its polished reputation suggested. Then the refinancing market shifted. Interest rates went up. Public debt became more expensive, and money wasn't as easy to find. This should have been private credit's moment to shine, and in a way, it was. Its role expanded. But with that expansion came massive exposure. Companies that would have eagerly refinanced their loans were now kicking the can down the road, hoping for better conditions. The maturity walls, the dates when all this debt comes due, which once seemed so far off, started inching closer. And since private credit funds were the main lenders to these companies, they faced a huge dilemma. Do they enforce the loan agreements and risk triggering defaults across their portfolio? Or do they relax the terms, kick the can down the road again, and protect those all-important portfolio marks? They chose the latter. Not because they were being reckless, but because they felt they had no other choice. A single forced default could have a domino effect. It could cause their own lenders, the banks, to get nervous, trigger renegotiations, or force the fund to raise more money at the worst possible time. The path that once offered flexibility had narrowed into a tight corridor of obligations. But the most profound shift, the real mid-script twist, was the quiet realization that private credit had become systemic. For years, everyone saw these deals as unique, isolated, and insulated from each other. But when the economy tightened, strange connections started to appear. Borrowers in completely different industries started showing the exact same strains. Cash flow problems started to synchronize. The need for loan amendments started stacking up across entire portfolios. Lenders who thought their risks were neatly compartmentalized suddenly discovered they were all exposed to the same vulnerability, the layers of leverage built into the entire ecosystem, which magnified even the smallest bit of stress. Behind the scenes, the language began to change. You'd hear new terms, like roll-forward adjustments and EBITDA-bridge add-backs. The phrase amend and extend went from being a last resort to a quiet industry standard. Valuation committees started spending hours scrutinizing assumptions, not because new information came in, but because the old information just didn't feel right anymore. Privately, some lenders would admit what they were really doing. They weren't managing credit risk anymore. They were managing time, just trying to stretch out the clock long enough for the economy to turn around. But time isn't a cushion. It's a narrowing runway, and here is what the public still doesn't see. The fragility of private credit isn't just about the health of the companies it lends to. It's tied to the intersection point where the leverage inside the lenders meets the leverage inside the borrowers. A single missed projection at a single company no longer affects just one deal. It threatens a whole chain of agreements, valuations, and credit lines that all depend on everything performing exactly as planned. The perceived safety of private credit evaporates the moment you realize that every one of these bespoke contracts is connected by one shared, unspoken assumption that stress will remain isolated. And that assumption is the system's single weakest point. Because when stress stops being isolated, when amendments start to cluster instead of being random one-offs, when refinancing options shrink instead of expand, the entire architecture flips. The system goes from being flexible to being brittle. What looked resilient becomes purely reactive, and what was once praised as a stabilizing force in the market becomes something else entirely. A structure that is hiding its own fractures until they become so aligned that they're impossible to ignore. That is the twist. That is what's happening right now, behind closed doors. The silence from this market isn't proof of stability. It's evidence that the system is holding itself together with a patchwork of terms, adjustments, and extensions. And if you look closely enough, you can see that the very foundation of private credit is already beginning to shift in ways that cannot stay hidden forever. To really get why private credit is teetering on a major structural cliff, we need to dig into how leverage builds up inside the system. This isn't the stuff you'll see in public reports or news headlines. We have to peel back some pretty technical layers that most people just assume are too complicated to worry about. But that's exactly where the system's biggest vulnerabilities are hiding. It all starts with a simple fact. private credit funds have become increasingly dependent on leverage. It's not just about juicing returns anymore. It is about meeting the high-yield expectations that big institutional investors got used to during a decade of near-zero interest rates. Just look at the numbers. According to Prekin, assets in private credit exploded from about $315 billion in 2010 to over $1.5 trillion by 2023. That is a nearly five-fold jump. But what is hidden inside that growth is the real story: the increasing use of fund-level leverage. The Bank of England estimated back in 2022 that for many big direct lending funds, this leverage was somewhere between 1.4 to 3 times their capital. This leverage was rarely talked about openly. When it was framed as just a harmless tool. But history shows that in non-bank credit, leverage amplifies fragility a lot faster than it amplifies returns. Let's break down how this works, layer by layer. The first layer starts with capital commitments. Private credit funds raise cash from pensions, endowments, and insurance companies' investors with long-term horizons looking for steady yields. But here's the twist. Instead of using that investor money right away, many funds first draw on what are called subscription credit lines. These are short-term loans secured not by the assets they're buying, but by the investor's promises to provide capital later. These credit lines let funds delay calling on their investors' cash, smooth out their cash flows, and close deals faster. Before 2010, these subscription lines were used for short periods, maybe a few weeks or months. But by the late 2010s, things changed. According to a Fitch review from 2021, some funds were rolling over these subscription line balances for 12 to 24 months. Why does this matter? Because it's the very first stage of leverage accumulation. We have borrowed money being used to finance loans that investors think were funded with their own equity. The second stage of leverage happens at the deal level. The rise of private credit came hand in hand with the spread of something called unitranche loans. These combine senior and junior debt into a single loan with one blended interest rate. They're marketed as being simpler for borrowers, but for lenders, they hide layers of risk. These unitranche deals often carry effective leverage levels similar to the risky leveraged loans we saw before the 2008 financial crisis, but without the same transparency. LCD data showed that by 2022, the average debt-to-EBITDA multiple for these middle-market deals hit 5.5x. The third layer is found in the waterfall structures that govern how everyone gets paid. Most private credit deals have these payment waterfalls that dictate how cash flows from a borrower are distributed. Interest goes to the lenders, then principal payments, fees, and sometimes equity-like returns. When times are good, these waterfalls work just fine. But when a company's cash flow weakens, these waterfalls become a source of major stress. For example, if a company's earnings or EBITDA fall so much that they can't cover their interest payments, they have to ask their lenders for amendments. Or they rely on add-backs, a kind of creative accounting that got more and more common. A 2020 analysis by Covenant Review found that these EBITDA adjustments had inflated unadjusted earnings by 30 to 45% in many middle-market deals. These add-backs made loans look healthier than they really were. They delayed the recognition of stress and allowed lenders to keep their valuations high, which in turn supported their own leverage. Now for the fourth layer, the financing that banks provide to the private credit funds themselves. There's this narrative that private credit operates outside the banking system, but that's not really true. Banks are deeply intertwined through credit facilities, repo financing, and other hybrid credit lines. The Financial Stability Board reported that by 2021, major banks had over $250 billion of exposure to private credit funds, mostly through senior secured loans. These bank loans often have borrowing bases tied to the value of the fund's portfolio. So, If the value of the assets in the portfolio goes down, the bank might demand more collateral or cut off the fund's ability to borrow. In a system where private credit valuations rarely get marked down in real time, this creates a hidden fragility. The stability of the bank financing depends on valuations staying smooth, and those smooth valuations depend on no real stress ever showing up. It has a loop that only works as long as the system can avoid a real confrontation with credit problems. The fifth layer is all about refinancing. Private credit loans typically mature in 5 to 7 years, which creates a predictable cycle of refinancing. But to roll over these loans, lenders need to be confident that borrowers can handle their payments in a new and potentially higher interest rate environment. And that's exactly what we got. As rates shot up from near zero in 2021 to over 5% in many developed markets by 2023, the interest burden on borrowers skyrocketed. A Moody's report from late 2023 estimated that for many middle-market companies, their interest coverage ratio, their ability to pay their interest, had fallen to below 1.6x. Just 3 years earlier, it was 2.5x. This erosion forces lenders to modify the loan terms, not necessarily to reduce risk, but to preserve the loan's valuation on their books and avoid a domino effect through their own leverage facilities. Every amend and extend deal, where they just kick the can down the road, pushes the entire structure closer to a breaking point, a point where all this delayed recognition of stress becomes a systemic risk amplifier. And that brings us to the sixth and final layer, the dynamic between investor expectations and lender incentives. Big institutional investors poured historic amounts of capital into private credit because they were sold on the idea of stable returns that were uncorrelated with the public markets. And for a while, it worked. Cambridge Associates reported that top-decile private credit funds delivered 8 to 10% annualized returns between 2010 and 2020, blowing past most public fixed income benchmarks. But those returns were heavily dependent on stable valuations and a carefully managed flow of cash distributions. As the underlying leverage in the system grew, funds had to keep their IRR, their internal rate of return, looking good. They did this through structured refinancings, recapitalizations, and sometimes even selling assets between their own affiliated funds. This created a self-reinforcing loop. The incentive structure was set up to reward hiding problems rather than dealing with them. Recognizing losses or even just acknowledging a bit of credit deterioration risked shattering the illusion of uncorrelated, stable performance. So, the system evolved towards concealment instead of transparency, pushing leverage accumulation deeper and deeper into hidden corners of the financial world. Each of these 6 layers, from subscription lines to investor expectations, has built upon the last, creating a complex and fragile architecture of leverage. Understanding these mechanics is the key to seeing the real risks that have been quietly building up just out of sight. The 7th layer manifests in covenant structures. Think of covenants as the early warning system in a loan agreement. Historically, they were tripwires. If a borrower's financial health started to weaken, these covenants would trigger, forcing both the borrower and the lender to sit down and address the problem before it snowballed into a disaster. But the game has changed. We've entered the era of covenant-light deals. By 2021, it was estimated that less than 10% of new private credit deals had strong, meaningful covenants. Many agreements now include such broad adjustments to earnings like EBITDA add-backs that the original purpose of the covenant is completely diluted. Without these guardrails, lenders lose their ability to step in early. What should have been a controlled, manageable restructuring becomes a delayed, high-stakes confrontation. It is a problem that might only surface when multiple companies in a fund's portfolio are all in trouble at the same time. This is where fund-level leverage meets portfolio-level weakness. pushing us toward a critical threshold where leverage stops boosting returns and starts magnifying losses. That brings us to the eighth layer, a scarcity of liquidity. Private credit is, by its very nature, an illiquid asset. You can't just sell these loans on a public market tomorrow without taking a massive haircut. The secondary market is still very thin. Yet, paradoxically, many private credit funds promise their investors, the limited partners or LPs, regular payouts and opportunities to cash out. So, how do they manage this? Typically, they rely on the cash flow from their healthy, performing loans, or they tap into their own lines of credit. But here's the catch. What happens when the whole market weakens? Like we saw during the global growth slowdown of 2022 and 2023? Suddenly, cash flowing in from loans slows down just as more investors are asking for their money back. Data shows that after 2022, it started taking funds much longer to raise new money. The time to close a fund jumped from 12 months to over 18 months. This fundraising slowdown puts even more pressure on funds to keep using their own internal leverage, even as the external economic environment gets tougher. The ninth layer is all about correlation, specifically refinancing correlation. Private credit funds often deploy huge amounts of capital in cycles, meaning many of the loans in their portfolios have maturities clustered around the same time period. When the first small wave of loans comes up for refinancing, lenders can usually handle it. They can amend the terms, extend the deadlines, it's manageable. But what happens when multiple, larger waves hit all at once, especially in an environment with high interest rates and tight liquidity? The correlation becomes a massive problem. A recent report indicated that over $200 billion in private credit loans are set to mature between 2024 and 2026. That is a highly compressed refinancing window. This concentration makes the entire system incredibly sensitive. If that window tightens at the wrong moment, funds will have to stretch their resources to amend loans across their entire portfolio, effectively just kicking the can down the road for the whole system at the same time. The threshold is crossed when the sheer scale of loans needing intervention overwhelms the system's ability to patch things up. Now for the 10th and most crucial layer, the dangerous dance between valuation inertia and leverage triggers. Private credit portfolios are valued quarterly. These valuations are based on internal models and comparisons to similar transactions. The key thing to know is that these marks tend to move very slowly. The industry operates on the belief that private assets are insulated from the wild swings of the public markets. But here's the critical interaction. The credit lines that funds use to get leverage, often from banks, come with strings attached. These strings are often tied to the valuation of the portfolio. While the fund's official valuations might be lagging, the banks providing the leverage are watching the underlying fundamentals in real time. If they see things deteriorating, they get nervous. They might tighten credit or demand more reporting. Then, if the fund is finally forced to mark down its assets suddenly, perhaps because a few public deals reveal much lower prices, it can trigger a breach in their borrowing agreements. This is what some in the SEC have called valuation synchronization risk, the danger that multiple assets have to be marked down all at once. This can force a fund into a corner, needing to sell assets at fire sale prices, raise emergency capital, or renegotiate their own debt from a position of weakness. So let's put it all together. We have 10 layers building on each other: reliance on subscription lines, leverage within unitranche loans, stress in the payment waterfalls, dependence on bank facilities, strain from refinancing pressure from investor return expectations, weakened covenants, liquidity mismatches, clustered maturities, and slow-moving valuations. Each of these layers on its own is a manageable risk. But when you stack them together, they create a system where leverage accumulates almost invisibly, silently, until the entire structure becomes fragile. The architecture reaches a point where even a small shock can ripple through the whole system. This threshold isn't a single number or a specific debt ratio. It is the moment when all this interconnected leverage flips from being an engine of growth to an amplifier of systemic tension. It is the point where the very mechanisms designed to mask stress like slow valuations and weak covenants start to align and make the stress self-reinforcing. Has the private credit market crossed this threshold yet? No, not yet, but it's much closer than many investors realize. The system has become incredibly sensitive, not because every company that borrowed money is on the brink of failure, but because the entire system is now built on a set of fragile assumptions. It assumes that refinancing will always be available, that valuations will remain stable, and that performance across thousands of unique, bespoke deals will never falter all at once. When any one of these assumptions breaks, the system doesn't just bend, it shifts structurally. The leverage at every single layer is designed to react to signals, and once those signals of stress emerge, they can't be easily contained. The architecture of private credit was never built to handle simultaneous, widespread stress. And yet, that is the exact scenario it's slowly, quietly drifting towards. This isn't about predicting a dramatic crash or a sudden run on the funds. It's about the quiet, systemic convergence of pressures. A convergence that will eventually reveal just how much leverage has been packed into the foundations, waiting for the moment when the system finally reaches a tipping point that decades of calm have helped conceal. If there's one truth the private credit world prefers to whisper rather than shout, it's this. Systems built on quiet complexity don't announce when they've hit their limit. They reveal it slowly, almost subtly. Familiar patterns stop behaving as expected. Numbers that once drifted comfortably start to tighten. You get this uneasy feeling that the very tools once seen as solutions, like extensions and amendments, are now just signs that stress is no longer isolated. It's becoming systemic. What makes this next phase so delicate isn't that private credit is destined to break. It is that its entire architecture has matured to a point where resilience and fragility are sitting closer together than the industry has ever admitted. The real warning sign isn't some theatrical, dramatic event. It's subtle, almost introspective. It lives in the way incentives are now aligned, all pointing in one direction: preserve the appearance of control for as long as possible. All while the internal weight of accumulated leverage just keeps getting heavier. The next stage won't be triggered by a single, spectacular corporate failure. It will happen the moment the system reaches a point of shared pressure. That's when the mechanisms designed to smooth out volatility will start working in reverse. When amendments stop buying time, when interest burdens start eating into cash flows faster than anyone projected, when the big banks start reassessing the credit lines that these funds rely on, that's when the architecture begins to reshape itself. Not suddenly, but irrevocably. Private credit doesn't crash with the kind of noise we see in public market sell-offs. It reacts through constraint. Deals that once flowed with ease start to drag. Valuations that seemed rock solid suddenly demand justification. Portfolio discussions become longer, more cautious, focused on scenarios that once felt distant and theoretical. You can almost feel the structure tightening, as if the quiet confidence that defined the last decade is finally giving way to a more sober understanding of just how interconnected this whole system has become. And the most important implication here isn't just for the borrowers, the lenders, or even the investors watching from the sidelines. It's for the entire financial system. Private credit has grown so large that its behavior during a period of stress will affect everyone. Banks that once provided liquidity to these funds will start adjusting their exposure. Institutional investors who were expecting smooth, steady returns will have to confront the reality that private markets don't defy economic cycles. They just experience them on a delay. Borrowers who came to rely on that tailored, flexible financing will suddenly face terms shaped by conditions they never saw coming. And right in the middle of it all sits the architecture itself, trying to manage a transition. A transition from a decade of almost effortless expansion into a period defined by constraints that you simply cannot amend away. The very silence that once protected the system from volatility could become the silence that allows stress to deepen, long before anyone recognizes just how synchronized the problem has become. What we all need to understand is that financial systems rarely fail at their point of greatest complexity. They fail at the point where that complexity meets delayed recognition. The vulnerability of private credit isn't that it's opaque or innovative or even that it's massive. The vulnerability is that it has been allowed to grow under the assumption that stability can be engineered through structure alone. But structure without transparency, leverage without early intervention, and refinancing without true price discovery, they all inevitably lead to the same place. That convergence doesn't send shockwaves, at least not at first. It just changes the rhythm. It changes the pace at which decisions are made. It changes the tone of internal conversations, and it changes the willingness to project optimism into the future. And once that shift begins, the system's trajectory is no longer defined by growth, but by adjustment. If you take a step back and observe this world with the kind of calm distance that long-term observers need, you start to notice the meaning behind the warnings. Not the loud ones, but the quiet ones. The ones embedded in maturity walls that are creeping closer, in covenants being rewritten just to buy a little more time and marks on a balance sheet that holds steady only because no one has forced them to move yet. These are not signs of immediate collapse. They are signals that the architecture has entered a new phase, a phase where pressure is shared, not isolated, a phase where the accumulation of leverage becomes exposure to leverage, and a phase where the silence that once concealed fragility becomes the silence that precedes recognition. So the final warning is simple. Do not confuse quiet with safe. In systems built on layers and layers of leverage, silence is often the first indication that the foundation is shifting. The private credit market may continue to expand, it may keep attracting capital, and it may continue to present that image of stability that investors crave. But just beneath the surface, a threshold is forming. And once that threshold is crossed, the path forward is no longer a question of yield, but of endurance. It becomes a question of how long the system can hold its shape before the equilibrium resets into something more transparent, more disciplined, and far less forgiving. So stay with this story, because the next chapter isn't about collapse. It's about revelation. It's about finally seeing the true architecture that has been there all along, just waiting for the moment when the world is finally ready to acknowledge it.